good morning and good afternoon. Thank you all for joining our Loading the Dice webinar today, where we will discuss how flawed economics is risking your pension, savings, and future dreams. You can download our Loading the Dice report via the QR code shown on screen. My name is Hannah, and I'm part of the events and communications team here at Carbon Tracker. The intended runtime for this webinar is 50 minutes, depending on the number of questions asked, with a 60-minute hard stop. There will first be a short presentation of the key points before we move to answering your questions. If you'd like to ask a question, please do so via the Q&A function. Please do not send the question anonymously, and if we're unable to answer it live or if it requires a follow-up, the team will be in touch afterwards. A replay will also be sent after the webinar, as well as the link to download the slides. So Carbon Tracker is a not-for-profit financial think tank. Our vision is a fully decarbonized global economy well before 2050. All of our research converts climate science into financial risk and reward with the aim to accelerate the energy transition by mobilizing the financial markets. Our work, including this report, is free to access or download from our website, as well as third-party platforms and our YouTube channel. So joining us today is Mark Campanale, who, after 20 years in sustainable fund management, founded Carbon Tracker Initiative. Mark has served on various sustainable development and finance initiatives and is currently on the advisory board of GFANZ. So also joining us is David Russell, chair of the board at Transition Pathway Initiative. So Transition Pathway Initiative assesses companies' preparedness for the energy transition. And prior to this, David was head of responsible investment at the university's superannuation scheme, the largest UK pension fund. He has also served on a variety of boards and is currently a board member of UK SIF and a member of the FTSE Russell Sustainable Investment Advisory Committee. And Willemijn Verdegal, Chief Product Officer at Trex. Willemijn, an economist by training, has 20 years of hand-on experience integrating climate transition and physical risk into investment processes. Willemijn co-founded Trex, which challenges the current thinking by focusing on the development of nonlinear and systems change analytics offering for financial institutions. And her former roles include the UNFCCC, Lead Climate Finance Negotiator, OTEC Finance, and MSCI. This session will be moderated by Amy Owens, an associate analyst on our sustainable finance and net zero transition team. So Mark, over to you.
Thanks, Hannah. Appreciate it. Now, if you take us to the first slide. Just to put some context into this, there have been a lot written about problems with the climate risk models that have been used by pension funds, a lot written, not just by Carbon Tracker, by others, the University of Exeter, the Institute of Actuaries, and so on. Now, the bit that Carbon Tracker is focusing is on one very particular part of that, the damage function. Others have looked at tipping points, at narratives, fiduciary duty, or transition planning, but we've looked at the one specific part of the integrated assessment models, which is the damage equation, which converts into the scenarios you can choose for dollar damage. And that's usually expressed as a measure of GDP. And it's that damage function, which is, well, how big is the loss to your pension fund, that inevitably becomes the data point that a lot of pension fund trustees will look at. Can I have the next slide, please? So now, why are we here? Why is Carbon Tracker bringing so much attention and focus on this topic? It's because when we read some of these climate risk reports, which have been published by pension funds, you get statements like this. This is from the pension funds. We've used a worst case scenario for our physical risk assessment, 4.3 degrees of warming, increase in global temperatures by 2100. A temperature rise of this magnitude would result in catastrophic climate events. But they then go on to say, however, we believe that the overall risk to our portfolio is acceptable. And we'll see who it was that said that in the next slide. And this was a really important pension fund, one of the largest in Australia. And the modelling exercise followed a time when Australia had undergone some pretty horrific climate-linked losses. The 24 million hectares are burnt in multiple states and so on. So now, is this some kind of evidence for cognitive dissonance? It wasn't just this pension fund that was saying this, actually. It was quite a few. A lot of them were saying the the temperature of the planet increases to 3 degrees, 4 degrees, but somehow the pension fund wouldn't be affected in terms of the value of its assets. And that's why we thought we need to dig into this in a lot more detail. Can we go on to the next slide? Uh, so um, here's another example of a scheme that really makes the case for why you need to do climate risk model. Let's be clear about this. We think it's important that pension funds undertake this kind of analysis. This is from the Florida retirement scheme. There's no mention of climate change or climate risks, or there's no need, of course, for any TCFD, Task Force for Climate-Related Financial Disclosures type reporting. And well, in the UK, we need to look at how we incorporate climate risk into investment decisions. But in the US, which has seen a lot more of these climate impacts in other parts of the world, if we think about recent hurricanes and storm damage, they're probably better suited or better needed, given the size of some of these ones, to do this kind of analysis. And when we're flicking through Florida's report, there's a picture of, um, of some of the damage from climate. But here's a quote from the report: "Trust us, you need an estate plan." Well, our response to this was, well, trust us, you need a climate plan. In fact, all pension schemes, given the enormity of what's coming down the line, according to what the scientists are indicate, need a proper climate plan. And doing a climate risk report assessment is part of that. Next slide. Bring it slightly closer to home to Europe. You're beginning to see, I think you're beginning to see a pattern here. This is from the Norwegian Central Bank, the Norwegian government pension fund, who published a model. And here's some of the highlights. Well, the climate scientists are saying that 1.5 degrees of warming, which we're close to, if not at now, is dangerous. 3 degrees is catastrophic. 5 degrees of warming is unknown, including existential threats. But when we look at the report done by the Norge Bank done for them, there's that graph. 3.2 degrees Celsius increase in warming would lead to just a 0.69% fall in the annual economic growth rate. And it's remarkable just how specific they can be about that decline. So what we're seeing, and next slide, please, is of concern to us is this trivialization of climate damage impacts on the value of assets, or more clearly, a de minimis impact on the rate of annual economic growth. So this is from a UK pension fund, Shropshire. Over the coming decade, a 2 degrees outcome, according to the model used, the best climate scenario from a returns perspective, it adds 0.05% to annual returns on a timeline to 2030, whilst a 4 degrees outcome would be the worst, detracting by a 0.06% annually over the same period. Again, this trivialization of the impact on the economy of what might happen in the climate. Next slide. This is from another pension scheme. This is from the local government pension fund of Leicestershire. And there you've got those two scenarios, which we've highlighted in the red boxes. Over 5 years, a rapid transition would actually cause the scheme to lose 1.6% of annualized returns. But a failed transition over 40 years would actually only lead to a 1% decline in annualized return. So on an asset allocation invested, the lower bit, the lower part of the graph there, you can see 2050 at 4 degrees, just a 0.13% decline in the value of scheme assets. And what's important to notice there is that there doesn't seem to be much difference in the reduction in annualized returns between a 2 degrees warming outcome and a 4 degrees warming outcome on the impact of returns to the fund. Next slide. So some of us have said in reply to Carbon Tracker's report from the other year that we were using models that were out of date, 2020, 2021, 2022. This has just been published by Gloucestershire Pension Fund, and this was prepared for them by Mercer. And so what we've got here is a very sort of similar outcome. What we can note from all of these is that all of the models assume that the economy continues to grow at 2 degrees, 3 degrees, 4 degrees of warming. And what you're seeing here is the impact on returns of a failed transition, which is that purple dash, a limited transition, which is that brown line, a rapid transition, which is the green line, and then an orderly transition. And what you find there is that a rapid attempt to transition over the short term would actually, if you aim for 1.5, according to this assessment, you aim for 1.5, you would actually lose returns because of transition risk. But if you had a delayed transition or a failed transition, the impact on the scheme would not be that great. And you can see there that the difference on the impact on annualized returns between a failed transition, which would lose you, well, let's run through that properly. Over 5 years, a 1.5 degree scenario would be a shock to returns of minus 3.9% per annum, followed by a partial recovery, and that a 1.5 degrees scenario would reduce annualized returns by 0.8% over 5 years under a rapid transition. Under 20 years, longer-term physical damages begin to be priced in, and the failed transitions becomes the most impactful scenario. The failed transition causes a reduction in annualized returns of around 1.9% per annum, but over 40 years, physical damages are dominant, and the failed transition causes a reduction in annualized returns of around 1.4% per annum. And again, what you're seeing here is just very little differences between a failed transition and a partial transition. And so what I want us to think about is what kinds of decisions do pension fund trustees, what kinds of decisions are finance officers being asked to make here if the impact on returns is almost inconsequential? Do you leave it to a failed transition? Is it better to choose a delayed or failed transition over a 1.5 if 1.5 hits your returns? Next slide, please. So what's going on? And really there's two things going on here. Well, we know that the effect of climate change on the economy is a cross-discipline subject, which combines a quite uncomfortable teammates. You've got economics together with science and mathematics. And on the left there, you've got scientists who tell us that, as we've said before, that 1.5 is dangerous, 3 degrees is catastrophic, and 5 degrees has unknown, including existential threats. And you've got to balance what the scientists have said from a different discipline, the discipline of the economists and of the mathematicians, who are saying that 3 degrees of warming will only hit the economy by around 3%. And in an earlier work by Willem Nordhaus, and actually just published again this year, damages at 4.5 degrees of warming would only be 7% of output. And so what you've got is something which is completely at odds with each other. What is clear here is that both can't both be right at the same time. And yet these models are being widely relied upon by the financial system, by pension fund trustees, by regulators, by central banks. Next slide, please. Now, on the science of tipping points, led by Professor Tim Lenton at the University of Exeter and his colleagues, has become clearer more recently. What was thought would occur perhaps later on in the century has been brought forward, and Professor Lenton in 2008 thought that the AMOP, which is the circulation of warm water into the north, would begin to weaken probably around 3 to 5 degrees of warming. And this was a study in 2008. But in a more recent study by Professor Lenton from last year, he actually believes that this could actually be triggered at much lower levels of warming. Um, but there's been a misreading of Professor Lenton's work by Willem Nordhaus, who sort of in his book The Climate Casino said here, well, Lenton and his colleagues assess the timing the most important tipping points in their view have a threshold temperature tipping value of 3 degrees or higher on a timescale of at least 300 years. So he seemed to interpret Professor Lenton's work very, very differently. In fact, completely the opposite of what Professor Lenton is actually saying. And so what we've got again here is neoclassical economists interpreting the science in a particular way for their own purposes. Next slide, please. So I mentioned the tipping points effect. This is the concern of scientists more recently, that the collapse of the AMOC would pose critical challenge to food security, and if it was to collapse, it would lead to potentially a 50 to 70% fall in land suitable for wheat and corn globally. And just again compare that science to the economists, and the economists are saying that if the AMOC was to slow down a little, the global impact would be positive, at a 0.2 to 0.3%. And this goes up to 1.3% for a more pronounced slowdown. And so, again, you've got this complete contrast between what the scientists are saying, warning us that a dismantling of the AMOC, a weakening of the AMOC could lead to a fundamental change in the ability to grow food in the global north, and around the world for the key crops, but the economists coming back and saying actually this would have a net beneficial effect. And Professor Ransdorf at the PIC has said earlier this year that there's now a 50% chance, 50% chance of the AMOC tipping this century. Next slide, please. So there is some kind of disagreement about the effect of tipping points and the impact of a worsening climate on economic growth. And here we're asking you to sort of spot the difference between how the economists have prepared their damaged functions and a quadratic damage, which is one of the options to assess the climate damage impact, best captures the impact of climate change. Can we go on, please? But then when you expand that out, the timing out to much further, and increase the levels of warming to up to 4 to 5 to 6 degrees of warming, you can see how an exponential and logistic damage increase at 3 to 5 degrees of warming. But what's more consistent with the climate science is a 3 degrees warming impact, which would be catastrophic. And there we've imposed the Bank of England and also the Unisuper effect, where we can see there's actually the logistic, which is this a much bigger impact as you stretch the time out as the temperature rises. It's evident that the exponential and the logistic function are much more in line with the science, although the exponential may be unrealistic. So can we move on to the next slide, please? The science thinks tipping points are far closer than before the AMOC shuts down. So Tim Lenton had it at 3.5 degrees of warming, but more recently it's been brought it back to 1.1. So you can see there's a shift, and that we're probably more likely onto an exponential impact on the projected damages. And so what this is illustrating is potentially far greater impact on the impact on the economy, and far greater impact on the value, therefore, of pension fund scheme assets. Can we go on to the next slide? Now, we know that pension funds don't own GDP. They own representatives of GDP, stocks and bonds. So markets have to price a series of well, we have to project into the future and try and interpret what assets are worth. So we have the known knowns, things that we can model and can expect, and then we've got the known unknowns, what the future will bring, and then we have the unknown unknowns. And at the moment, the market is pricing a logistic, which is expecting, using these economic models from Nordhaus, that there'll be very limited impact on GDP, of very high levels of warming. But if we were to use a more realistic damage function, one where um, um, the uh, the damage would be far greater on the scheme assets in line with the climate science, we then have a whole series of areas which the market has failed to price. And as the amok potentially collapses and these steep lines move closer to in time, then you can actually have a period where the market has to begin to properly price these risks and these impacts. Next slide. So if we're to summarize the key takeaways, the damage function that's being used in these models by pension schemes and their advisors is not aligned with climate science. Our main takeaway is that this underestimates the physical damage of the planet of a higher warming, and overestimates the time to solve the issue, and has serious implications for financial markets. Tipping points are not just physical. So what we would like to discuss now, and I'll hand back to Hannah, is what does this mean? If our markets underpricing the impact of physical climate damage on the economy, and if so, what should pension funds trustees do? Hannah, back to you.
Thanks, Mark. I'll take over from here, and thanks for the presentation and highlighting that climate risk is not being properly priced in by the financial markets. Turning to our panelists then, we're all convening here to really share insights aimed at helping investors navigate this challenging issue. Starting with you, David, then welcome. A recent State Street commissioned survey of over 300 asset owners revealed that physical climate risks are their biggest concern, with 89% of the respondents claiming to have conducted extremely or moderate assessments and models of these risks. Does this align with your views and conversations you've had?
Good morning, Amy, and thanks for having me, and hello, everybody. The number does seem high, to be honest, but I think that some context around the survey. It was 300 large European asset owners, and in that, asset owners are insurance companies, pension funds, family offices, so a spread of different types of organization that were part of the survey. And I suspect some are doing better than others. Insurance companies are quite good, or better than most asset owners, or in fact other investment organizations, at looking at the physical risk associated with their businesses, because it's not only the investment side, it's also the underwriting side and understanding risk there. Some asset classes do lend themselves to better physical risk assessments, whether that's real assets, infrastructure, buildings, real estate. I suspect what's also been included here is bigger funds or bigger asset owners or asset owners using the climate data providers out there. So not necessarily just limited to the climate scenario analysis and modeling, but the data suppliers out there, MSCI, Sustainalytics, and a whole range of others who do offer services to do that kind of assessment. So I suspect that's how this has been calculated in terms of how funds are assessing physical risk. Is part of a broad set of assessments, and one of their data providers will have provided something. How meaningful that assessment is would be something for further discussion, I suspect.
Sure, and thanks for that. The survey also says that most of the asset owners are focusing on disclosure rather than asking for explicit company action. What do you think's going on here?
I think that hides some quite important information, actually. That disclosure request is, are companies providing scope 1, 2, and 3 information? Are they disclosing plans for their transition to net zero or Paris alignment or science-based targets? What governance are they putting in place to manage the transition? and some of the disclosures around, are they changing their business model? So I think so disclosure is a broad topic. It isn't just climate disclosure, it's how are they transitioning. But I think more generally, I think I know that pension funds and asset owners are beginning to think more about, okay, it's not just about what companies are saying, it's actually what they are doing in terms of their transition. What plans are they putting in place to guide their transition and targets they are setting? So I think it's we're moving away from just disclosure about information to real world changes. What is actually happening at these companies, and how are they going to be transitioning, and what they're saying about that? So yeah, so it is, disclosure is a broad thing, but I think investors are moving away from just asking about disclosure to, okay, what is actually changing at these companies?
And then that's a necessary development as well.
Yeah.
Willemijn, same question to you now. What do you think about this in the survey?
Well, I would echo a lot of what David said, but I'd like to pick up a little bit on how meaningful the physical risk modeling is that probably a lot of these asset owners and asset managers are doing. Because I would agree, I think as people are becoming more aware of the transition, not, yeah, we're seeing that these estimates are getting worse and worse around physical risk. So I think that sense of urgency around physical risk and physical risk being baked into the system, I think is really generating that concern, and I think that's rightfully so. However, I think there is a lot of deep issues with how physical risk is currently being modeled and sold to the market. A lot of it, for example, concentrates at the mean of the distribution. So not being too technical, but it looks at kind of, what's the most kind of natural point, like the middle of the curve of the distribution of risk. They're not looking at the tails of the risk. And especially if we're looking at physical risks, it is important to understand what is going to happen in those worst case scenarios. So I think that is very important. Also, so concretely asking your data providers, are you looking at distributions? Are you looking at those tail risks? Are you looking at compounding impacts, or are you kind of assuming that one hazard has nothing to do with another hazard? We are looking at Earth systems here, where there's a massive amount of interconnectedness. A drought may, cause a flood somewhere else, or vice versa, or a heat wave might actually trigger a cold front. These things are connected and should be treated as compounding. And so that's another question one should be asking. Tipping points was just touched upon. At Turks, we're very excited to be commercializing Tim Lenton's tipping point research, where we're looking at some of these near-term tipping points, not only as kind of independent scenarios, but also how they would impact tail risks and these compounding impacts. So I think it's really important. I've had a close look at some of these data providers out there, and often they represent indeed what is the damage to a building or a warehouse or something as a result of this physical risk. And that is not where the driver of risk is coming from. It is about how it's affecting, production of food supplies, immigration. It's looking about how they might impact the demand for goods and services, all kind of the critical risk drivers that are currently not being captured in most of the work that's ongoing now.
Thanks, Willemijn. And so Mark's presentation did really highlight this gap between the advice pension funds are getting and the effect that climate change is having on their portfolios, as well as what the climate scientists are saying. David, back to you. What are the pension funds? How are they responding to this in your view?
Yeah, so I think it's important to say that a lot of pension funds are having to do climate scenario analysis because they're having to do TCFD reporting, and that's been a driver in the UK. Outside the UK, I think scenario analysis is not as mandatory as in the UK, but you're still seeing a lot of pension funds doing it. And I spoke to a number of them earlier in the year for a project I was doing for a UK fund on scenario analysis. So I think the most important thing is that the numbers that are coming out aren't necessarily reflective of how pension funds are thinking. You have to publish the scenarios that you are using, and most use this top-down GDP focused approach. And the reality is people don't the funds don't necessarily believe the numbers. And from my experience at USS, the report is littered with caveats around don't trust the numbers. The numbers are just what the models throw out. And there's an absolute recognition that there's a disconnect between what the models are saying, particularly linked to financial returns, and the actual changes to the environment as a result of 2, 3, 4 degree, 5 degree changes in temperature, and what that will do for society. I'm staggered by the statement that UniSuper published. It just doesn't make any sense whatsoever. The world will be on fire at 4 degrees, particularly if you're Australia. So it doesn't make sense for them to make that statement. I think what's happening at pension funds now is they're moving away from that focus on just those bald numbers and taking other issues, information into account. So you don't rely on the scenarios that say the impact is relatively low over the long term. You say, okay, we think the climate's going to change. How do we deal with that as a fund? So you are beginning to see funds look at how they can use different types of scenario analysis to assess what the implications could be, and then building that into their asset allocation processes, or trying to, I think, is probably a better way to do it. So I think that the numbers coming out of this kind of modeling say one thing. I think pensions realize that isn't the real world outcomes of climate change, and are beginning to act on their own to look at how they can adapt their investment processes to actually address what is a very long-term issue.
On that point then, so if models are just one aspect that pension funds are looking at when it comes to influencing asset allocation, what else are they using?
So I think there's two things here: asset allocation versus what's actually happening in funds. I think very few funds have worked out how to incorporate climate change into, and the modeling that comes out of scenario analysis into asset allocation. I know there's a lot of work going into how that can be done, but that focus here on asset allocation isn't necessarily the right thing, because funds are doing stuff anyway around addressing climate change risk. As I said previously, they're looking at their allocations to more climate related assets, whether that's renewable energy or clean tech or VC funds that support the technology. So there's a broad range of allocations to the solutions to climate change. They're also looking at how they can change their allocations within their portfolios, like equity portfolio, fixed income portfolio, to tilt away from those companies that are more exposed to climate change or have heavy carbon footprints, to those that don't. So you see a decarbonisation of portfolios. I don't think that's necessarily the right way to go. I think a focus on how companies are transitioning, or how assets are transitioning, is a much more effective way to go. If you're just looking at carbon footprints and selling carbon heavy assets, you're not making any real world impact. You're just cleaning up your portfolio. And that's, for most big pension funds, asset owners around the world, you're tied to global decarbonisation, not individual asset decarbonisation, because you invest in sovereign debt, you invest in emerging markets, developed markets, fixed income, equity. So you have to focus on how assets are transitioning, not necessarily, or whether they are or they're not, and not necessarily what the carbon footprint is. So I think that there's a strong focus here, not just on what the models say. Pension funds around the world are actually investing in, or changing their more bottom-up investment processes to take account of climate change, rather than relying on asset allocation, because the current modelling, the kind of GDP top-down modelling, doesn't lend itself particularly to integration into asset allocation decision-making process.
Just quickly looking at the Q&A then, there's a good question here from Eva Grace on how do you position a portfolio for 100% fall in GDP? David Willermine, would you be able to comment on that now?
I don't think it's very difficult to, with no GDP, you can't position a portfolio to have no GDP. So I think it is, if the question's more, I haven't had a chance to read the question. If the question's more asking that, how do you change your portfolio to deal with a decreasing GDP, it's going to be very difficult. And one of the slides says is that pension funds don't invest in in GDP, they invest in individual assets. Well, actually, I kind of disagree with Mark on that. Actually, large pension funds are universal owners. They invest in everything everywhere. They are tied to global GDP. And as a result, they have an interest in addressing any issue, a systemic risk like climate change that could impact the global GDP, as well as that's made up of lots of individual assets. But in the end, it's how is the world dealing with climate change as opposed to BP or Shell or Tesco's or Marks and Spencers or the UK government. So it is how do we address climate change at a systemic risk level, and so focusing on how do we get the world to address climate change is much more effective, or pension funds should be thinking about how they can do that more effectively than how to focus on how Exxon is going to deal with climate change, because you can spend a lot of time doing that and not get very far. So that focus on, so I don't think a 100% decrease in GDP is something I could comment on, but a focus on how to address this systemic risk to global GDP is something that asset owners need to be better at doing.
Any quick comments from you, or I can ask another question?
Oh yeah. Mark or me? Sorry, I didn't hear.
You go ahead, Willemijn.
Oh, okay. Thank you. I have a lot more to say on some of the points touched, like models and implementation, and I can also touch on the question, just checking, would this be the right time, or would you like to go to Mark as well?
So can I just respond to David's point about GDP? So GDP is obviously it's a measure of growth in the economy, and what we're pointing out in our analysis is that you want to get degrowth, not growth, and all the economic models seem to be suggesting that 3 to 4 degrees of warming, the economy continues to grow. And I think that's the error point in it. The path that we really have to look at is wealth. So you're going to get the destruction of physical assets, property, land, the ability to grow food, the ability to manufacture. So what we should be measuring is two things, not just the decline in GDP or negative growth. We should be actually measuring the destruction of physical assets, physical wealth, and their financial proxies. So the representation of that wealth. I just have to if you just think of how much it would cost to move a nuclear power station from the coast to inland because of rising sea levels or extreme storm damage. That's a $20 billion write-off, and you're going to have to do the whole thing all over again. So we need to think about both sides of the equation, the loss of real wealth, as well as the decline in GDP, and then financial proxies or representation of that wealth.
Yeah, and I was obviously being slightly provocative there. Absolutely, we do need to, as large asset owners, you have a role in stewardship of individual assets, as well as that focus on as a universal owner. So you do need to make sure that the individual assets, or encourage the individual assets that you're investing in, to be managing this risk. And I think the challenge that both investors and corporates have is that individual focused data on, if you're a shareholder in BP, the physical risk to BP is massively diversified globally. A lot of it is by the sea, admittedly, therefore sea level rise is going to have an impact. But if you're just looking at the physical risk side, it is which assets are most at risk, and how should BP be reporting those to their investors, and how are they managing that risk? And if it means moving a refinery because it's going to be underwater in 15 years' time, they should be planning for that. But yeah, it is.
David, are you seeing pension funds then really starting to think about this concept of universal ownership in light of these physical risks? This is a question linked from what you've previously just said by Olivia.
So I think that, so the concept of universal ownership, it comes from the 1990s. Hawley and Williams, if you ever want to look it up. So it's not a new concept. I think post Paris, post the COP in 2015, there has been a stronger focus on systemic risks and the role that investors play in that, because they own slices of the market. So yes, I do think that large investors, large asset owners and pension funds, do think of themselves as universal owners and are working out how they can respond to that. And I think a strong part of that is not just engaging with individual assets, is engaging with policymakers and markets around how they're addressing these issues. And it's not just climate change, it's antimicrobial resistance, it's nature and biodiversity. There's all sorts of issues that are larger than one company or 10 companies in a portfolio that need being looked at, because if you own a slice of the global economy, you need to be looking at how that issues are being addressed, not just by BP or Tesco's, it's how the whole market is addressing them.
In the models and the analysis and the advice, you're seeing that transition risk seems to be a far bigger threat to the value of assets in the short term than physical risk would be in the longer term.
Yeah.
And one thing that, I mean, we talk a lot about a carbon tracker is how the energy system is being transformed and being decarbonized purely by swapping out technologies or replacing an old energy system based on fossil fuels with a new one. And so by definition, it is transitioning. So it almost seems to be that moving away from the fossil fuel system to back the new energy system is actually a way of avoiding transition risk, because you're going to be investing in the new dominant energy system. I know, Willem, and you work on a lot of these models, but the concept of the energy transition doesn't seem to be appearing very much in these models. This idea of getting rid of a high carbon energy system. We estimate that something like half of corporate bonds are linked to the fossil fuel system and about a quarter of the equity markets. But moving away from them seems to be inevitable given the speed and the scale of the clean energy transition.
Yeah, Mark, I couldn't agree more. And there's so much to say around this. Maybe to start with some of these models, because what we're seeing, like the NGFS, central bank, mainstream models, they use so-called equilibrium models, which assume that the market is always in perfect equilibrium. So anything you do to change will automatically be a negative result. So it's really important to understand that these models are not able, by the way they're built, to capture opportunities at all. So that is a massive problem. They are also are not set up to capture shifts in demands for goods and services that may happen in the real economy. So, for example, we're talking about physical risk, but also your energy system. Because technologies change and a better, cleaner, cheaper energy system is emerging, that will shift demand, for example, for more traditional combustion technologies. These models are not fit for purpose. They cannot capture it. So basically, and maybe just also to bring it to the NGFS, we welcome their upgrades, but frankly, they're polishing and building on a not fit for purpose foundation. So I think what I would be advocating for strongly is a shift to more realistic, pragmatic models that capture these real world dynamics and also on a shorter term decision useful horizon. And talking about decision usefulness, also looking at extreme weather and focusing especially on hazards, because hazards and extreme weather events are actually going to be what is going to be material on, say, a 10-year horizon. That has nothing to do with damage functions, very different modeling discipline.
The way I read these models, it seems to be, if you're a pension fund trustee or finance officer, it seems to be saying avoid transition risk. Don't try and go for 1.5, and you'll be able to weather the impacts of physical risks because they're going to be so much smaller. Now, that if you're a layperson as a trustee and you're a teacher or a social worker or whatever, you're not going to be, and you'll be reading this. What are we expecting people to go away with, and that's decision useful? I mean,
Mark, I want to come back to Willemijn, and we've already started talking about the problems with the mainstream economic approach now. Willemijn, you're at Trex and you are working on a science-based approach to some of these challenges. You've already started to touch upon it now, but can you elaborate on that some more and explain what your product is and how it's offering something different to the mainstream economic approach? And also, you've already talked about multiple hazards, but Sarah has a question which asks you, have you seen any modelling research that does compounding of these multiple hazards? So if you could respond to that too, that would be great.
Thank you. So a bit on the Turks offering. Yes, we really are working with some of the major UK asset owners actually to develop an alternative, like a hard alternative to what's currently out there in the mainstream. David talked about universal owners and how important it is to understand how everything is interlinked. So that is very much the position we're taking. We're looking at these issues through the lens of systems change analysis. And we're starting with that with the energy transition system. But we are very much about how things are interlinked. Not everything can be quantified given the current state of the modeling. That's why we are also pushing this narratives-based approach, which is a little bit more of a qualitative way of looking at things, so that at least you are kind of fleshing out the different types of storylines you should be thinking about. From there, we're quantifying them using very pragmatic models that really take on kind of non-linear impacts and translating that to a macroeconomic data set. And from there, because we get from our clients in the end, they want to build resilient portfolios and indexes. They are also very interested in what does that mean for individual stocks and bonds. So we're translating it all the way down, which is a absolutely unique offering in the market today. We're first to think about it in this holistic top-down and bottom-up approach. So really taking a step back from thinking that emissions equals risk, and kind of any kind of way of thinking about emissions times carbon price as a good indicator of risk. It is not, because it's about understanding how the impacts of shifts in demand impact companies' revenues and valuations from there, and also linking that to the physical risk part, where we are working, like I said earlier, with Tim Lenton and the team at University of Exeter, where we will actually be bringing to market in Q1 of next year a hazards data set that incorporates tail risks, compounding impacts, and tipping points on the basis of that scientific research. So we were very excited about, finally being a pragmatic answer, an implementable answer to kind of this building sense of frustration with the current status quo.
Great, thanks. And so you've already mentioned that the Network for Greening the Financial System has an updated set of scenarios. They came out last month. Mark, can you start us off by talking about the update and what was updated essentially?
Well, I think and Will and mine should comment on this. The main thing that, from my point of view, is what it missed, and what it missed was the effect of tipping points. And I think that we've come and it was an important part of the slide that I was using, that the consequences of the physical impacts and the timing of when this is likely to happen, to absence them largely from the discussion, or boot the problem into the future from an analytical point of view, I think was probably misplaced, because it gives people the sense that you can ride through 2 degrees and 3 degrees and things won't be so much worse than how they are now. And actually, once you've gone past tipping points, if the amok was to weaken and ultimately to collapse, I mean, this fundamentally reshapes the global economy and is probably irreversible for hundreds, possibly thousands of years. We don't know. I mean, once you flip it, it's very difficult to flip it back. It's not like a switch. It's not easily done. So that's my main issue with the NGF update. But Willem, I'm sure you've got some more detailed thoughts.
Willem, it'd be good to hear some more from you on this, but also the impact of the update on how these climate models are going to be developed moving on, and then how that translates to the advice pension funds are receiving from their advisors.
Yeah, so maybe first of all, I do welcome that, you see they have taken some of the criticism on physical risk on board and have implemented a different damage function. Is it decision useful? I would say no, because damage function still is very, very much about very long-term impacts, and it's very hard to kind of translate that back to, you know, which assets are currently at risk on, say, a 10-year horizon. Also, what's really important to understand is that they're still assuming significant, like say, normal GDP growth in the baseline, but then subtracting a little bit from that due to the damage function. So you're not actually getting into any territories of negative growth or significant issues. So I think that's still, yeah, a lot of underestimation going on there. I am very happy at least that the signal is going in the right direction, that a higher warming does look more risky than a lower warming scenario if you look at their, you know, macroeconomic results. However, we can really wonder if the order of magnitude is, you know, in any way correct. And it's very hard to see you know, what pension fund trustees can actually do on the back of this information, because the granularity underlying the models in terms of sector and regions is quite poor. So how will you then translate this to actually taking decisions in your portfolio? I mean, very practical questions that we get at Trex is, you know, how does this translate to my concrete holdings? How do I actually build a resilient, climate resilient index? You know, and which companies and regions could I be investing in? Where are the opportunities? You know, in that same State Street publication, they said that a lot of these asset owners are very interested in understanding opportunities. Like I said before, these scenarios by definition don't give any information opportunities. So, you know, that's a real drawback. So frankly, I welcome the ongoing work. I think that's great, but is it really getting us to anything decision useful is very much my question, because they are still, you know, it doesn't really, the features in the model, the assumptions are actually do not push the dial or give different outputs as much as what modeling philosophy are you actually working with. And, you know, they've taken the wrong fork in the road from the very beginning. They've built this whole card house, if I may say so, on the wrong modeling discipline, or one that is not fit for purpose for understanding risks and opportunities in a messy, changing macroeconomic and real economy environment. So, you know, it's great they're trying to improve it, but I think a more fundamental rethink of the basics is actually what's called for here.
Thanks, Willemijn, and very conscious of time now, so I'm going to ask you a final question. Given the limitations that we've discussed on this panel and also Mark's presentation, what would one piece of pragmatic and real-world advice would you all give to those involved in the decision-making process that will help with the decision usefulness of these models? David, let's start with you.
Don't rely on the current models. And just a bit of context for that. Some of the pension funds I spoke to earlier in the year haven't published the outcomes of their scenario analysis because they don't trust the models and they didn't want to have their names tied to them. So the current model, it is the top-down GDP is not decision useful. So don't trust the models. Look at what the climate scientists are saying. The world is going to be very different in the future, and how do you going to address that through the allocation of your assets? And I didn't use asset allocation there because I don't think currently the scenario analysis that is being used generally is fit for building into the current approach to scenario analysis.
Thanks. So models should not be used as a standalone tool then. Willemijn, how about yourself?
I would say don't use current mainstream models as a standalone tool. And I would say just, you know, ask your data provider, are you taking systems change analysis into account? Are you looking, what models are you using? Are you including nonlinearities? Are you looking at demand changes? And I just think I would say really support you know, many of us in the market that are trying to do a better job. don't be afraid to mix qualitative and quantitative approaches in your decision-making processes. They are both approaches that have their strengths and limitations. Yeah, keep trying to push the envelope and be very, very critical about what you're using.
Thank you, Willemijn. And Mark, what about yourself?
I've been thinking about a lot. I mean, I was in the fund management industry for 20 years and actually worked with pension funds and trustees. Is what is the change in what kind of directives or instructions are trustees and finance officers giving to their external fund managers if they use external fund managers? What kind of decisions change as a consequence? So we're kind of being told here, don't go for a rapid transition. When actually, Willemijn, our points about the speed of the clean energy transition, you should be leaning into this. Net zero is a destination. It assumes that we've removed fossil fuels from the energy system within the next 20 years or so. So you actually have to build an investment strategy which actually does that, switches you out of high carbon into low carbon and supports the energy transition. But the advice seems to be saying to you, well, actually don't do that. Don't huddle in the middle, stick with what you normally do. And then when it comes to the fund managers, if you said to a portfolio manager, the value of this, the whole physical impacts on a company, it could be a mining company, it could be a food company, over the next 10 years is going to be transformative to the negative side. Can you build a financial model that actually builds that into how you value a security? I don't think most fund managers are really doing that because they don't see this coming down the line. They're still stuck in a business as usual mentality.
So what would be your one recommendation then?
Build a proper financial modeling to value securities as if there's going to be a significant energy transition and as if there's going to be potentially huge physical impacts, and see how that changes the weightings of stocks that you decide to own as a pension fund. And
Thanks,
then have a
Mark.
discussion about it.
Thank you.
Maybe to capture it, it's don't go for low carbon portfolios, go for climate resilient portfolios where you treat the energy transition as being baked in, because it is. What's happening in electric vehicles in China and India is enough to cause, asset stranding without any kind of further policy being implemented whatsoever, and take into account those baked in physical risk, especially around extreme weather, as we see that coming up in the next decade or so.
Thanks, Willemijn. And that is all we have time for. We have an upcoming petrochemicals report coming out tomorrow, and we've got another webinar on the 17th of December, which is our Absolute Impact 2024 report launch. So do stay on top of those. Now, I want to say a massive thank you to the panelists, and thank you to the audience for being here and for your questions. And a final thank you to the event organisers and everyone behind the scenes.